Good afternoon, this is Mike Bertelsen, the Bear Market Investor, the market update for Monday, August 29, 2011. We're here looking at the patternsite.com, specifically at the Elliott wave double zigzag pattern. The reason I'm showing you this pattern is because I believe that's exactly what the S&P 500 stock index is tracing out from its third wave low. The double zigzag is simply two zigzags, as you can see right here, two simple zigzag, which are the most common form of correction in Elliott wave analysis that are connected by a three-wave connector here. And its incomplete form, a double zigzag looks much like a triangle formation. Triangle formations are very, very common to see in a fourth wave. And in fact, only with the difference right here being of this leg, it is easy to see where you can mistake one for the other. That's why I wanted to actually use this as an opportunity to more or less show exactly what the S&P 500 was doing and why the pattern I believe to be a triangle was not. Now, the difference was I had actually mistaken this particular wave right here. This really being the critical one, unfortunately, in that particular pattern. In some cases, you can have wave structure that either look like a 5 or a 3. Because waves really develop in many different ways, and you have to account for a little bit of give and take in the wave structure in order to determine what the proper wave count is. You know, that count essentially would have us like this: an A wave up, a B wave down, a C wave up, a D wave down, and then an E wave up. Now, we have crested above the peak that we had in the S&P 500 at this point right here. That was at 1208.47. We inched above that ever so slightly. There is no triangle formation that I'm looking for anymore. In fact, the top count that we can place on the fourth wave here is that, in fact, it is a double zigzag. And we'll be looking at the S&P 500 stock index in the hourly time frame in just a moment. But I wanted to show you this because this is a great way to teach Elliott wave to people by showing them even mistakes, simple mistakes of differences in wave recognition. And so that's why, looking at and understanding all the different patterns that can come up is very important, because this, if not the triangle, this would have to be the top, top count that we have, and now it is, because in fact we did crest that peak right there. Now let's have a look at the S&P 500 stock index and see where we might be going in the days ahead here. Okay, we're looking at the S&P 500 stock index in the hourly time frame. First, I want to show you the double zigzag pattern that we have here forming in the fourth wave of the larger 5-wave decline that we're expecting to complete sometime in the near future here in the S&P 500. Now, that, of course, has us with a zigzag here followed by a 3-wave connector and then another zigzag. So that count goes like this: A wave up, B wave down, and then a C wave up, followed by that 3-wave connector in the form of an X wave, followed by an A wave up, a B wave down, and then a C wave up that is currently under construction. Now, interestingly enough, we did end up at that 1209.89 area, just ever so slightly above this, which was 1208.47. And we ended up smack dab on our long-term resistance and support line, going all the way back to the 2000 peak in the S&P 500 stock index. Now, what I think is so fascinating about this is that we had that shoot up right away in the morning, and then we were inching ever so slightly up towards that resistance line right there. We closed right on it. In fact, we did fulfill the minimum requirements here for the double zigzag pattern. However, I think we probably have a little bit further to go, or at least we can allow a little bit more to the upside before finally completing this C wave right here. Now, where I went wrong, and where I think is a teachable moment here in Elliott wave analysis, is that I was counting this as a first leg up, second leg down, and then third leg up to complete the C wave in the triangle formation. That, of course, is very common in fourth waves. From there, of course, we did have a very clean 3 waves down. Then we had something that looked like it was probably the first leg up, second leg down. We had to inch ever so slightly higher, coming below this peak right here to complete that E wave. So that was really where I went wrong right here. This particular wave right here probably is the third wave, but it looked just a little bit too short for me to really consider it a third wave. Now, third waves don't have to be the longest. However, there is a rule. The rule is that it cannot be the shortest wave. Now, when I was eyeballing this here, this did look like it was pretty darn close. May not have been the shortest wave, but it was pretty darn close, and certainly looked to be fairly short from a third wave perspective. So I was combining that with this peak right here that I believe to probably be the top of this first leg up, and then the second leg down, and of course the third leg up, in that we had a divergence start to carve out there on the MACD histogram, ushering in that decline right there. Now, interestingly enough, too, earlier on in the day, we did have a little bit of a divergence here in the RSI and the hourly time frame that I was talking about. Unfortunately, it didn't stay that way. We did, in fact, get to about an equal peak here in the RSI, eliminating more or less that bearish divergence there. But we do have a bearish divergence in the MACD histogram. This is also a good indicator here that, you know, we're starting to slow down as far as momentum is concerned. We're starting to just about end this C wave, even though, like I said, we can allow for a little bit more upside. Now, double zigzags are often good to channel like this. First, you take the bottom of the A wave, you connect that with the bottom of the X wave right here. You form this line right there. Then you essentially copy and paste that exact lines above it here, and there you go. You got a channel for that double zigzag. So of course we can allow for a little bit more to the upside before completing, but we did meet that minimum requirement, which was really that we move slightly above this particular top of the zigzag pattern right here. So I am allowing for a little bit more to the upside. But this also forms another type of pattern in technical analysis, and that's called a bear flag. Bear flags often can be double zigzag or even triple zigzag formations. So, you know, when you're seeing something that people consider to be a bear flag, look to see, do you see that double zigzag or even a triple zigzag formation there in that bear flag? Because that'll tell you something. That'll tell you probably, if it's a bear flag like this right here, that you're probably getting some sort of corrective wave, and if that breaks down to be a double or triple zigzag, great. Then you can see what the Elliott wave structure tells you, because bear flags are of course continuation patterns, you know, to the bearish, or from the bearish perspective, that would have the market continuing to move down. And so I believe that's really what we have here, is a bear flag in the form of a double zigzag. So I hope that also shows you a little bit something here about how to channel these and what those bear flags can actually represent in some cases. So let's wait and see what happens over the course of this next day or two. My guess is sometime really soon here we'll you know, inch perhaps a little bit higher and then finally complete that C wave. Certainly we do have something that looks like we could be nearing completion, that we have a first wave up, a second wave down, a third wave up, maybe a small fourth wave down, and then we're working on that fifth wave right there. And that should probably end that C wave. Now, this could really just all be part of the third wave right here, and that we'll still see a pullback and then a thrust to the upside to complete that C wave. But I wanted to show you kind of that breakdown in wave structure. Of course, use this as an opportunity to teach wave analysis and where I went wrong in counting this, because that type of thing can happen to even the most seasoned Elliottians, that these types of counts go wrong. It's just something that happens. Fourth wave triangles are very common, so I don't really expect that we're going to see too much more upside. I think a lot of the pain here is in this small leg up here that we're going through. Even though it's a large number of points, I think it still represents a fairly minimal retracement here of this larger third wave down. So again, let's wait and see what happens over the next couple days, but I think we're going to see the end to this double zigzag pattern pretty quickly. Hopefully it doesn't turn into a triple. That would be more pain for us bears to endure here. But we should see the completion of that fifth wave to the downside, which should bring us, certainly well below, or at least below this third wave bottom here, to complete the minimum necessary requirement for 5 waves down. But I certainly suspect we're going to extend maybe another 50 points beyond that. Have a great night.